Welcome back, everyone. Today's video is going to be a bit of a market update video because the market has been doing a lot recently and I have not. So frankly, I figured I would tell you what I'm thinking and why I haven't been doing anything. So without further ado, let's get to it. So I do have bull points and bear points to make in today's video, but one of the things that I wanted to mention right off the bat is from a sentiment perspective. The level of bullishness in the market is one of the things that's making me uncomfortable. There's a lot of it. Sentiment surveys will show you, depending on which one you look, that there's a lot of bulls out there. And now it is important to understand that sentiment can be flimsy. You know, you could have a 3% pullback, 5% pullback quickly, and all of a sudden all the bulls could disappear. So it's not a end of the world type thing, but the extreme amount of bullishness is not bullish. That said, one of the most important things to do in the market is to let your winners be able to run and turn into big winners. So that means holding through an extended, hopefully holding through an extended bull case. So when I break things down and start looking at the signals, what is the market telling you, telling me is happening? Well, they're mostly bullish, and I don't know how long they're going to stay this way. I don't know. It could be tomorrow, next month, half a year. Who knows? But, you know, Dr. Copper, it's at its highs. The high beta sectors and the sectors that normally lead bull runs, they're doing well. Long end of the yield curve is steepening, so we're pricing in some inflation or some economic acceleration out there. Inflation expectations are up. GDP accelerating, bullish. Dollar, you know, the US dollar is a snowball. Pushing it up the hill, it makes things more difficult for everyone. Pushing it down the hill, you know, makes things easier and easier for everyone as it continues going down. So the dollar moving lower is bullish, and not only bullish, but helping everything get better. If that continues, I expect the bull run to continue. Will it? Who knows? And the last thing is gold has been underperforming recently, consolidating, whatever, but a number of things have moved higher while gold has not, which again is telltale signs of a bull run continuing. So what does this mean is my general plan? Well, I kind of hinted at it earlier in terms of try to let the market move without hurting myself, without playing around and causing myself issues. I won't catch the top. I know it now. I might sell too early, might sell too late. And by the way, I'm not a professional. If I think things have changed after something has fallen a little bit, I'll get out. And I have no problem with not catching the top. I have no problem with not selling on a day where things have moved up. You know, if things change, if it looks like the signals of turning, or if I'm not liking a position, not liking the risk reward anymore, or think there's something better, I'll move out. And again, my last thing that I think is very important for myself is to be very sure to not get caught up in the story of today in the market, the narrative, you know, whatever it may be, whether it's inflation or whether it's economic, you know, disintegration, whatever the type of thing that currently people are thinking, concerned about, fearing, whatever. Things change. Change is the only constant in the market. So I have to watch for signals for that. And when there's no signals, sit on my hands. And that is the plan. Now, in terms of some more sobering opinions, there's certain segments of the market, certain pockets where valuations are becoming concerning. Now, we've seen periods of high valuations, of low valuations, and now we are in certain pockets in a period of very high valuations. Now, part of this is because interest rates are low. They're, well, very low, historically low. And so that is gravity. And there's very little gravity for things, and then there's momentum, and then there's all sorts of things. In the longer term, be careful with what you're buying, know what you're paying for it, because I think that will matter in the end. Now we don't seem to care because things are moving up. Many sectors, success is priced in my opinion, that doesn't make for a very appealing risk-reward setup, valuation going forward. So whatever it is that you're buying, know what you're paying, know not some future price target, but what will it actually be worth. And as far as rates go, I think there's one thing that's very important to understand. Rates are low for a number of reasons, but mainly because there hasn't been inflation, there hasn't been a need to raise rates. So if inflation starts and then persists, then there will be an excuse and maybe even a reason to normalize the world. Now, that will have its issues, and I'll talk more about that later, but it's just important to understand that valuations are high because rates are, partially because rates are low, and rates are low because there's no inflation, and there's no inflation because growth estimates keep disappointing. So if that snaps to the reverse, all of a sudden you could have questioning of valuations because rates are rising because there's no inflation, and meanwhile the cost of business is rising because there's inflation. So it can be a snap in the other direction. So just be aware that that is a possibility. And it's important to understand that commodities are the opposite of this. Commodities thrive off inflation, economic strength, and that type of thing. So if there's inflation, if there's booming economy, from here, I would say it's very likely that if that happens, commodities continue to outperform. And there has been recently perhaps a bit of a shift because we're back to talking about inflation again for the first time in a long time. I saw a chart that showed inflation expectations basically breaking above a long downtrend. So that's something to watch. I know there's always inflationists out there, always deflationists, and they're both sometimes right. And what's next? Very unclear. So now I just wanted to outline a little bit more what would happen, what would be the sequence of events if inflation persists. And there's a big if. So what we would likely see is more of kind of what we've been seeing in the yield curve in terms of the long end would continue to rise, as we've seen with the 10-year recently and longer term bonds. So the interest rates would rise because investors would need a bit more of a premium, and as the market is pricing in future inflation. On the short end, however, and that's where rates are raised, I think the Fed would be overly cautious, and as they were in the early 2000s, because you saw a bit of we saw the housing bubble, which ignited after the dot-com bubble, which was an issue because the Fed, you could ask Stan Druckenmiller about this, failed to raise rates as soon as they should have after that bust. So I think something similar might happen this time if we could find the inflation to start the process. Now, note that the long end can keep rising, but not forever, because if you look at the financial situation that many governments around the world are in, they can't afford to pay back. It becomes harder and harder to pay back as the rates rise. So at a certain point, and I don't know where that point is exactly, I think that either slowly or quickly, yield curve control would likely be discussed. And so who knows, maybe if things start booming, maybe if the economy starts booming, we won't see that, it being an issue because things are growing fast enough to pay off the debt. More likely, there's talk of yield curve control, and if any of that gets implemented, I think all commodities would likely do well. gold, everything really, because it would be a sign that the central banks are unwilling or unable to adequately fight inflation, which sounds pretty bullish for commodities, frankly. I mentioned gold, so I will just put my opinion here. Before yield curve control is implemented, I will remain near term, short term, cautious on gold. Why? Because this real rate moving in the background, moving higher, which if it continues due to inflation, inflation may be bullish for gold, but the real rates will be a headwind. I'm not saying gold will go down. I'm saying might underperform. And people might say, okay, well, there's inflation. That's always been bullish for gold. And it is. But the problem is we're talking about marginal little moves. So the people that bought gold as a safe haven because interest rates were zero all over the world or negative, now there's less negative or even positive interest rates. So some of those people will sell a little bit of gold. And so it's important to recognize that changes are small changes on the margin. So on the margin, real rates rising is a headwind for gold. And that's really all I wanted to say on gold. This video was intended to be more generalized markets thought rather than commodities. But if we're talking about inflation and that may be a factor in the markets near term, I kind of need to mention commodities. And so there are people that will say commodities have had a long bear market and we haven't had a commodities bull market. And while that is mostly true, I wouldn't generalize and say that all commodities are screaming buys today. I think actually most are mid-cycle prices, maybe slightly above. I know that may be unpopular, but it's just how I see. Now that said, most, if not all, are in a positive trend. So, if they're mid-cycle, then they're heading toward, most will probably be heading towards higher in the cycle. And, there's full cycle investment opportunities depending on where it's going next rather than the value within the cycle. So commodities, there's going to be some good ones, going to be some bad ones. Don't really want to get into specifics here, but they're very cyclical and inflation kind of moves up the base rate for all of them. So if you're betting on inflation, you're betting on economic strength, they probably all go up, but to different degrees and, different amounts of leverage in different places. So on stimulus, now that we're heading towards a period with perhaps more government certainty and perhaps a more cohesive view towards stimulus, we may see it. And that may come in many forms. It really depends what in terms of how to play it. Is it more of what we've seen in terms of checks to individuals, or is it infrastructure or whatever? In any case, I would think that there's certain metals, probably the more industrial or economy focused base metals, would probably have more of a relative benefit. But that being said, I would be cautious of any, if we start seeing parabolic moves up in commodities in the coming days, perhaps before stimulus is, before it's announced what it would be, I'd be cautious. Why? Because, there could be a lot of buying thinking, oh, when stimulus is announced, we're going to see moon. Well, there's a lot of people looking at the markets and many of them could probably see that stimulus is coming. So if it gets too excited before that, it may be a bit of a temporary sell the news event. We'll see. Obviously if the real demand continues, then the price is supportive fundamentally, but we have to watch out. But for now, in this environment, I still think it is a bullish environment for commodities, and perhaps even after stimulus is announced. It really depends on how much expectations the market has beforehand. So my positioning, I remain long steel and long some more volatile energy sectors. because I think the marginal shift up in, economic reopening, bullishness, fundamental demand improvements, I still think those are highly tethered to that. I do want to mention these are not forever positions. Cyclical, highly cyclical things are not forever positions. The industry will survive, but the positions will have extreme volatility. Now, my bet is that the upside volatility will happen first, but I don't know when things will change. I don't know if tomorrow I'm going to want to sell. I don't think so. Or if it'll be in months or years. And that is really the question. And for now, I'm thinking it's going higher, but I don't know when that changes. Now, I know how much I've spoken about uranium, and I do want to point out that while it is inflation hedged as its commodity, it's not specifically what I'm talking about when I'm talking about stimulus or economic reopening. It's just not economically sensitive enough. Look, when there was a global shutdown, the price was flat. If something was highly economically sensitive, the price would be down like 30% more. Of course, I'm talking before the supply shut in. So I'm talking about things that have more torque in both directions. So overall, we have had a bit of a move, but I'm not ready to sell yet. I'm somewhere between buy and sell. I'm pretty long the market and not really anxious to add more. I think likely near-term dips are viable in pro-cyclicals, things, that go up when the economy's good, because it is, it was very bad. It's getting less very bad, and it's improving. Is it improving instantaneously? No, but it's looking more optimistic. I don't know how long it's going to keep looking more optimistic. I don't know if this is just a cycle or if it's a super cycle. Impossible to tell at this point. But for now, things look like they're heading higher to me. And I guess that's it. So thanks everyone for watching. Hope you enjoyed. And until next time, have a great day.